Okay. Good evening, everybody. Nice to be here, and thank you, Funke, for the invitation. I haven't done this in quite a while, so I might be a little bit rusty, but I'm sure there'll be something for everyone to take away. So Funke has asked me to talk this evening about equities, shares, and funds, and tax efficient investing. So we'll try to get into that. To say a little bit about myself, I'm not an investment professional in any way, shape, or form. I'm not in finance. I've not got a finance background. I actually met Funke in medical school, so I'm a doctor by training, but I've left my clinical skills, packed my clinical skills to one side, and I run a business. But I'm based in the UK, run my own small business, and I've just generally loved investing for about a decade and a bit now. So I've dabbled in the stock market, and what I'll be sharing is just personal experience, really. And like I said, I'm based in the UK, so I haven't got the North American slant that, a lot of you might have, those of you that have been investing in the US or in Canada. But I have a lot of friends and family in those areas, and I do quite a bit in the US stock markets. So that's pretty much where my background is from. So I'm a little bit of an imposter in a sense, but yeah, we'll probably share a few things that we've learned along the way. And if anyone has any questions or any suggestions, anything to chip in, just, let's feel free. Use the raise hand. Use the raise hand feature, and we'll take it from there. Right, so I'm going to share my screen, and then we'll try to get into this. There's quite a bit to get through in terms of the slides, so I'll try to limit what I say about each particular topic, as it were. But if anybody feels that they want more details about a certain thing, just ask in the chat box, and then we'll take it from there. So the way I've structured the presentation this evening is we'll do a bit around, just basic investment advice, just things that I think would be helpful to know if you're planning to go down this route, or if you're already on this route, just things to have in mind. And especially around goal setting, because it's always good to get that basis or that benchmark right before you jump into investing, so you don't end up being caught up with some of the things that I've had to learn from mistakes or by experience. And then we'll do a little bit around stocks and how to buy shares, the practical side of things, how to do some due diligence when you want to buy shares, which shares to buy, that sort of thing. And then we'll look a little bit around risks, around buying shares, what the good side or the downside are. All of us are Nigerians, so everyone's kind of, I don't know if everyone's had any experience being burned by the Nigerian stock market. Anybody? No?
Yes, 2000.
Yes. Exactly. So we've all bought into, I don't want to call it the grand Ponzi scheme that is the Nigerian stock market. It works for some people, but in the long run and in the large scale of things, it doesn't really work. Everyone has some sort of horror story. But yeah, being in a developed country like UK or the US or Canada offers a lot more in terms of investing, and doing it from an evidence-based standpoint or from a research-based standpoint really, really works in good stead for savvy investors. So let's jump straight right into it. So in terms of basic investment advice, I could share my slides, later on with Funke so that she can share it with you all. But I'll just pick on a few things to that would probably come in handy as you go along the road. I always say begin with the end in mind. If you want to build a stocks and shares portfolio, decide within yourself, what's my investment plan? How much do I want to end up with? So that you don't get caught up in doing things out of fear of missing out or investing from an emotional standpoint. So have a figure in mind. What do I want? Do I want $1 million? Do I want $10 million? Do I want 100 million? Decide, pick a currency that you want to work with. So if that's a Canadian dollar, Naira, US dollar, pound, whatever it is, pick that currency and use that as your benchmark, your personal benchmark, and set your investment goals against that currency and determine what good looks like for you and what's the end point. Because if you don't have that end point, you continue to throw money at things and you continue to make investment decisions that don't really always end up working out. So begin with the end in mind. Define clearly, what do I want to get out of this? The next thing is you need to build your own internal capacity. So when I sent out the survey link, and I've looked through a few of the responses, I've seen that quite a number of people are interested in investing, quite a number of people are already investing. But a lot of us, the majority of us, rely on free information websites to for our finance education, for our financial literacy. So, you know, Investopedia, investing.com, what we can get for free. Now, there's a wealth of information that sits on those websites. And if you're diligent with learning from them, you gain a lot over time. But there's a lot more that sits behind paywalls, behind good financial resources. So try to find a way that you can either pool resources with friends to invest in things like Motley Fool, Financial Times, Forbes, you know, trying to find those programs, those resources, those journals, those publications, because thinking about building a portfolio of $1 million is like sitting on a company that's generating $1 million a year. So look at yourself internally and say to yourself, can I manage $1 million if I won the lottery right now? What's my capacity? What can I manage in terms of money? If someone gave me $1 million right now, will I just go mad and just go and buy a car, buy a house, you know, and just go on a spending spree? If you're not able to multiply 10,000 and make it 100,000, you need to find the resources that help you build the skills to make 10,000, 100,000. Then you'll be able to manage 100,000. You need to find the resources that help you manage 100,000 and take it to $1 million. So sit with yourself and look at yourself and say, what do I have the capacity for? There's no point aiming for $1 million if you can't manage 10,000. Not going to work. So, you know, look within yourself, ask yourself, what are my true skills? How much do I earn annually? How much can my employer entrust me with? If I wanted to start a business today, you know, how much can I truly manage? And then you build up from there. And the thing with investing is, the more diligent you are with it, the more you learn as you go along, the more you earn. It's just, you know, and 10 years, like I said on the survey, is a good timeline for you to start a journey. So if you're at that point where you think, okay, I want to do a little bit of a reset, set an investment strategy, set an investment plan, give yourself a 10-year timeline to, you know, build up to $1 million or build up to 5 million. And, you know, you can gradually take the steps that take you there. So I've put a few, resources that I generally look at on a day-to-day basis. And yeah, these are a big part of my own financial education, and I look at them every single day. Okay, so the next thing to note, I think, around basic investment advice would be due diligence. Due diligence is absolutely everything. You don't have to put your money into everything that's available. You only need to put your money into those things that you're absolutely sure of, that you know about, those companies that you can bank on. They're almost, you know, sort of like high conviction investments. Once you put your money there, then it's a waiting game. It's about letting the market do its thing, and then you give it time. So you don't need to have 100 shares in your portfolio. You don't need to have 50 shares in your portfolio. In fact, most of the big investment professionals, you know, Warren Buffett, Charles Munger, they say you only need 20 to 25 stocks as an experienced, seasoned investor in your portfolio. And you can build wealth around those 2025. But if you feel you don't even want to go that far, start with 5, start with 10, then build it up gradually. If you can put $100 or $200 in every month, then on that 5 that you're sure of, just say, okay, I want to build it up to 5,000 in this company. So if you pick maybe Facebook, for example, Facebook covers WhatsApp, Instagram, and Facebook itself. So then say, okay, I'll put in $200 every month until I have $5,000 in Facebook shares. That's how you build your portfolio to a sustainable point. Or if it's a company like Coca-Cola that pays out dividends and you can reinvest your dividends in buying back more shares, then you can tell yourself, I want $10,000 in Coca-Cola shares. Then you start with, 200, 500 gradually, and then you keep building it up that way. When your dividends come in, it gets reinvested until you build it up to 10,000 in Coca-Cola shares. So have that sort of mindset that I'm going to start with what I know of and I am sure of, and then I gradually build it up that way. Okay, and then the third thing I'll probably say, the fourth thing I'll probably say about investing due diligence, which we as Africans tend to be a little bit afraid of, is legacy. So you always need to think, where is this investment ultimately going to end up? If I'm not going to one day sell it and blow the cash, how will I transfer it to my children? How will I transfer it to my grandchildren? What taxes will I have to pay on it? How does it go on my will? How does it go into a trust fund? Think about legacy every time you're investing. They say there are 2 certainties in life: death and taxes. So always think about legacy whenever you're planning for investment. When you're planning your investments, think, how do I reduce or minimize my taxes? If I'm going to give it over to my kids, what's the inheritance tax liability that will crystallize, when I transfer these shares? And how does it, work in that sort of sense? So that way you're taking a long-term view, to things. So that's pretty much it in terms of some basic sort of guidance. There's a few more tips in there which you can read through when I share the slides. Okay, someone's saying this presentation is very rich. Could we possibly have it alongside the recording? Oh, okay, all right, that's fine. So yeah, you get the slides as at the end of the presentation. Okay, all right. So there's a little bit here around goal setting. Again, I'm really very particular about the why of what you're doing before the how. You need to know why you're doing what you're doing before you jump into how. So 2 quick tools I'll share when I send out the slides. One is the Wheel of Life, and that's embedded in here. Wheel of Life is good because it helps you balance money against everything else. It helps you balance money against your education, your career, your family, your social life, against everything else, so that you don't lose balance. Life is about balance, and as Christians, we need to be able to keep things in perspective. You're not going to become richer at the expense of other people becoming poorer. So you want to invest from a balanced standpoint and from a place of wholeness, and you want to keep all of those things in check. And then the other thing, which a few people mentioned in the survey that they would like, is a financial plan template. Okay, so with your financial plan, let me see if I can quickly bring that up. What you want to do is, can you still see my screen? Yeah, okay. So this is a very simple template that I've just drawn up this evening. And what you want to do is, put down your name or your family name.
Dr. Funke,
yeah.
Are you sharing the template? We're still seeing the goal. No, we're still seeing the goals.
Oh, I see. Okay, hold on a second. Let me,
Setting page.
Okay, so can you see this now?
Can you hear me?
Yeah, I can.
Okay, now we can see it.
Yes. Okay, now you can see. Okay, all right. So this is a very simple template that I came up with it, and I put just a few examples in here, and it just helps you come up with very smart SMART goals, you know, something that's achievable, realistic, time-bound, that you want to have for yourself. So, you know, you put down who does this plan belong to? Does it belong to me or to me and my husband or my family? What date have I put it down? And what's my next review date? So what's my checkpoints for when next I come back to this plan? So I've put in here exactly 1 year from today, okay? And the vision is 3 things. So you need to capture it as very crisp, clear bullet points. I want to retire within the next 5 years and have $3,000 monthly in passive income to support my spouse and I in retirement. Okay, I want to retire in 15 years and have this amount monthly in passive income. So that passive income is money that's coming in from shares, your property, from, you know, you're not actively working. I want to pay for my children's Ivy League university education. You know, I want to be able to leave 1 property to each of my 3 children in my will. So you've got a long-term, you know, horizon statement, vision statement that you've put down as these are my investment goals. This is what I want my investments to achieve for me. It's not just about building money and having money in the bank. And then you set your timelines for short term, medium term, long term, okay? And short term here I've done within the next 6 months to 1 year, within the next 1 year to 3 years, and then within the next 3 years to 5 years. You can change your timelines as you wish. You can do 6 months, then 1 year, then 2 years. Completely depends up to you. And then you look at your investing from, or your finances from the point of view of your assets and your liabilities. So for my earnings, how much do I want to be earning from my salary? How much do I want to be earning from a side hustle or a side gig? How much do I want to have in shares? How much do I want to invest every month? You know, for my property, how much do I want to save away for a deposit for my property? And how much do I want to be keeping up with my rent so that, you know, my credit score is in a good place? And then with your liabilities, how much do I want to reduce or bring down my liabilities in the short term? So my mortgage, my credit card, my car finance, the personal loans I've taken out from friends and family, how do I want to wipe them down within the next 6 months or within the next 1 year so that, you know, I'm able to minimize my liabilities and maximize my assets? And what you need to do with every plan is always have a contingency. So within the short term, if you know, think that, okay, from my side gig, extra cash might come in, make a plan for it. So just write it down. If I get extra cash from this, I'll divert it into this. If I'm not able to overpay on this debt, when I get extra money from here, I'll put it into it. So always create a contingency with your plans. So you see that I've done this example for just the short term, and I put a contingency plan for the short term there. And then you can, you know, do that for the medium term and the long term as well. And always create a contingency. So the simple Word document, you can tweak it as you like, and I'll share it with Funke after the meeting. So let's go back to our slides. Sorry, I hope I'm not going too fast. Am I? Am I going too fast? Good. No, I'm good. Okay. Any questions at this point? No? Okay. All right. So let's get into stocks and funds then. So stocks. Does anybody here own a business or anybody run a business? Is anybody entrepreneurial here? Anybody? No? We're all in 9 to 5s. Okay, so that's fine. So essentially, it helps, you know, understanding shares from the point of view of a business owner. You know, it's the unit of business ownership is a share. And that's exactly what buying shares means. You're buying into a unit of ownership into a business. Businesses raise finance in 2 major ways. They either raise debt, which is, you know, they go out and take a loan, or they raise equity. They sell shares in exchange for, they give people ownership, you know, in their company in exchange for money. So that's what buying shares is. And you're buying a piece of equity in the company. And when you're doing that, what you're saying is, I believe in this company, I believe in their products and in their services, I believe in the management team, I believe that they have the capacity to generate profits. And from those profits, you know, they'll pay out dividends. And I believe that when they grow their revenues, the value of the share will grow. So it's, if you're a business owner, it makes it easy to sort of understand, well, that's what you're doing when you're buying shares. You're not just buying something that you're hoping will appreciate with time and then you can sell it for some money. You know, you're buying into what that company stands for and what they do. And it's a great way to own any piece of a business, from a small SME to a multinational blue chip that's, you know, doing business around the world. Shares are a fantastic way to buy into businesses. And businesses are, you know, the engine of the global economy. Businesses make everything run. If there aren't businesses, nobody will pay taxes, and then governments will dry up, you know. So businesses are a fantastic way to grow the economy. And stocks are traded on stock exchanges. It's like a marketplace for you know, equities. So they're usually geographically located because, you know, they are regulated by the financial authorities of the jurisdictions in which they're based. So you find that in the UK, we've got the FTSE. In the US, you've got quite a number of exchanges. You've got the New York Stock Exchange, you've got the NASDAQ, there are quite a number of exchanges. In Canada, you guys have the Toronto Stock Exchange. In Germany, there's the DAX. In Tokyo, there's the Hang Seng. So every jurisdiction has its own, you know, stock trading exchange. And within that exchange, they will trade local equities or local commodities. So shares of companies based within that jurisdiction or domiciled within that jurisdiction. And they'll also trade shares of other jurisdictions as well, as long as there are multilateral arrangements or agreements in place between those countries that allow them, you know, trade across borders. So, you know, on the H stock market, you could buy shares, you could buy funds, you can buy bonds, you can buy derivatives, you can buy, you know, different sorts of products. And the way they perform is usually marked against an index. So an index is like a hypothetical collection of all the companies that are on a stock exchange, or they might pick the biggest 100 or the biggest 500 of the companies on that exchange, and they'll aggregate all of their performances together. So they can aggregate their performance by market capitalization, or they can aggregate their performance by earnings, by profits. And they say, okay, these are the biggest 500. And then they average that out and it creates an index. So that index is what they use to measure the performance. If they say the S&P today is at, you know, 17,000, that's the average performance of all of the companies. They'll say, you know, in the next 1 year, it'll probably be trading at about 19,000. That means the companies have, as a whole, you know, gone up in value. So that's kind of like a very simplistic explanation of how stocks are traded and how stocks work. So how does this now concern you and me? How do we buy and sell shares? Traditionally, what we used to do would be, or what our dads and our moms would do, would be to go to a stockbroker and they'll sell you shares and give you a share certificate. And, you know, at the end of the year, your dad will put all the share certificates together. But with the advent of technology, we now have trading platforms online that allow you buy and sell shares individually. You can even buy a fraction of a share. So you don't need to, if a company like, say, Tesla, that's 1,000, they can buy 1,030 or 1,035 today. If you don't have up to 1,035, you can buy half of a Tesla share on some trading platform. They can buy 1/10 of a Tesla share on some trading platforms. They let you do that now. And yeah, so what trading platforms also offer is they offer accounts. They offer different types of accounts and investment products that allow you buy your shares into. So if you think about a bank has a current account, a bank has a deposit account or a savings account. So the same thing with the trading platforms. They have pensions accounts, they have savings accounts, they have tax-free accounts. So you can open up an account, you know, and then put money into it. But the money you put into it, you use to buy shares. And then when it appreciates, you know, you can then liquidate out of that account. So what is good, and we'll talk about it a bit later, is tax efficient investing. You need to find how to buy your shares into a tax-free account, so that when you put money in some places, because that money has come out of your salary, right, and you've paid tax on that salary, the government, as an incentive to make people invest more, will give you back that proportion of tax that you've paid into that account. So to give an example, if, say, what's your tax rate in Canada? Basic income tax. Okay, I'll use the UK. We're at 20%. So if you know, I wanted to put in $1,000 on in a share account, 20% of that is 200. So I'll put in 1,000. The government will top it up with 200, right? So when I'm buying shares of $1,200, right? So I've already gotten my tax money back, isn't it? Then when those shares appreciate, if it appreciates after maybe a year or two and it becomes 2,000, I'm supposed to pay capital gains tax on that 2,000 because, on the 800, because it's gone from 1,200 to 2,000, isn't it? So I should pay capital gains tax on the 800 that my shares have appreciated by. But because it's in a tax-free account, I don't pay any capital gains tax. I take all of that profit and I take it in full. So tax-free accounts are a fantastic way for you to buy shares into. You might think, it's a little money, but when you do it over time and it compounds, it actually saves you quite a lot of money and actually adds a lot back into your investing. So if you're doing any investing in shares, please look through the trading platforms and make sure you're doing one through a tax-efficient account or a tax-free account. Okay, so one other thing to note about trading platforms is the fees that they charge. So some trading platforms will charge their range of fees, their trading fees, which is the fee for buying and selling. So every time you buy a share, some trading platforms might charge, $8, $9, £8, £9. Some will say free trading, or some will say you pay $30 for all the trades you make in 3 months, in 1 quarter. So you need to look at the different platforms based on the fees that they charge and pick the most efficient one. I'll go through a few examples for different jurisdictions now shortly. If you're buying shares that pay out dividends and you automatically select for your dividends to be reinvested, so once you get dividends, it's automatically reinvested for you. There's a commission or a management fee for that because somebody has to click the button to do that for you. So some trading platforms will charge a commission for that. And then there are currency exchange fees as well. So if you're say in Canada and you want to buy shares in a company in the UK, there are currency exchange fees. So just bear that at the back of your mind when you're picking a trading platform to use, or you want to review your shares accounts. Just look through the different platforms and what their charges are. So I did this slide for presentation I did a while ago. So just disregard those countries that don't apply to you. But these are some of the best trading platforms according to Google for trading in different jurisdictions. In the US, TD Ameritrade, Fidelity, Charles Schwab, E-Trade, Interactive Brokers, Merrill, TradeStation, Robinhood. I know there's Vanguard as well, which is really quite good in terms of having funds. In Canada, Questrade, Qtrade Investor, Interactive Brokers, TD Direct Investing, CIBC. I mean, I don't know how. I did this a year ago, but I still checked it today, and these were still some of the names that it was coming up with. Does anybody use any of these platforms at all?
Direct investing.
Pardon? Interactive, okay.
No, TD Direct Investing.
Oh, TD Direct Investing. Okay, that's fine. I think they're the same ones as TD Ameritrade. Yeah, so that's a good one. Robinhood, yeah, that was a very popular very popular platform last year during the pandemic and still seems to have quite a bit of traction. Okay, so let's look at which shares to buy. Qtrade, Questrade, yeah, okay, that's good. So, you know, Google kind of still has it bang on then. We're all familiar with these platforms. Okay, so which shares to buy? So there's so many companies on the stock exchanges. I mean, finding the right company to buy or the right shares to buy can be a bit of a maze, you know, it can be quite overwhelming to pick. And, you know, from the survey I sent out again, I saw that quite a number of us, the majority of us rely on our friends and families' recommendations, which was really quite interesting. But the thing is, generally, what I've learned over the years from investing is you never really get it right until you're able to do your own research. You know, even the analysts who predict and who say, oh, this stock is on course to hit X amount by the end of the year, they're all guesstimating. Everyone is just projecting, you know. So until you're able to do your own research, develop some sort of confidence in yourself and in your research skills, and you know, be able to put evidence from different sources together, that's when you start to have, so it will take a while, is what I'm trying to say. It will take a while to get to the point where you're, you know, able to say, right, I have a good feeling about this. I have a good feeling about this company. But also the good part of relying on friends and family is also if your friends or family are in a particular sector of the economy, say technology, for example, you know, they maybe work in Google or they work in for a company that supplies Google or Apple parts, then they know that sector, they know that niche in and out, and they know who the players are. So if they're giving you information, it's reliable to the extent that you're able to go up and do additional research on. So it's a really good, useful nugget to have if you have friends or family members who are able to give you that sort of information as well. So it's not to discard, you know, getting information from recommendations from friends and family, but know that you need to be able to do your own due diligence around which shares you invest in. So you can invest in shares for a number of, you know, along a number of criteria. You can invest based on returns, which, you know, is the number one reason why you're investing anyway. So income versus appreciation for every asset class that we put money in, be that property, shares, gold, whatever, there's the element of income, which is, you know, paying out little units of returns based on annual trading or regular trading. And then there's appreciation. The whole bulk of capital that you put in will appreciate over time. So you want to look at, am I investing for income? So purely for the regular income that I'm getting from it, which is dividends in this case, or am I investing for the capital appreciation, capital growth, or do I want both? Because some shares are good for both. Some shares are good for one or the other, but then some shares are good for both. So what you want to do then is look at which companies are offering dividends on a yearly, quarterly, half-yearly basis, on a regular basis, which companies are growing and growing quickly, you know. Set your portfolio up in a way that you have a balance of both, okay? Because some shares that are primed just for dividends don't necessarily grow dramatically. So the Teslas of this world, they don't pay out dividends, right? The Google, the Amazon, they don't pay out dividends. They're good for growth, but on the day you decide to crystallize or realize that growth, that's it, you're out. You know, you're selling out your stake in the company. But the Coca-Colas, the Johnson & Johnsons, the Procter & Gamble's, they're good for dividend because there is slow, steady on the growth side, but their dividends are steady every single quarter and their dividends increase every single year. So we'll do a little bit of how to look at dividend shares and how to look at growth shares, but that's what you're looking at from a return sort of perspective. you want to look at the performance of the company again. So some companies on the growth side are phenomenal, in terms of, picking up and moving. I mean, I don't know if anybody has been invested in Shopify over the last year, or companies like NVIDIA, Trade Desk. Those are companies that have done remarkable returns, 300, 400, 500% over the last 2-3 years. But when you look at their share price against their earnings, they're very expensive. They're quite expensive. Okay, so there's some financial analysts that have a trick or a method of investing called value investing, where they look at the fundamentals, they look at the balance sheet of the company, and they look at how much should this share be trading at. It's really very tricky financial analysis, because it means you really know that industry or that sector. You really know what the earnings per share and the price earnings ratio, the PE ratio, should be. So if they say, for example, the PE ratio in the food and beverage industry is about 25, that means if you put in $25 against the share, at the end of the year, it will give you $1 of profit. That's what essentially the PE ratio is. So it's the share price against the earnings per share. So if I put in $25, it will give me $1 profit at the end of the year. So it's about 25. But you find a company that's trading at a PE ratio of 60. That's expensive for that sector. So you're looking at, what are they doing? What are they spending on their overheads? What are they paying out in terms of salaries? There are big executives at the top that are taking a lot of fat cat salaries. So there's some analysts that are able to say that, okay, if the average is 25, this company is trading at 17. So this company is actually at a discount within this sector. By the time it gets up to 25, share price would have grown. So it's a good time to buy it at that PE ratio of 17. But like I said, you will need some time of investing or financial education to be able to analyze PE ratios up to that point, except if you have a good finance background. I mean, I know Funke is a finance guru. There might be others like you here who are able to do that sort of analysis, but it takes, looking at a company's accounts over a 12-month period, a 2-year period, a 5-year period, to be able to look at, right, this is how the PE ratio has grown over time, and if this company is trading at a discount or not. Or you just look online and say value shares in food and beverage, or value shares in entertainment, or value shares in tech, and then you start doing your research from there. Google is really very good with getting out financial information if you use it well. Or there might be market segments, industry sectors, or countries that you're interested in investing in. So, you can say, fine, I like tech, I work in tech, I know tech, and I just want to put my money in tech companies because, they're the big deal now. Or if you're like myself, who's got a healthcare background, I know healthcare, I understand the supply chain, I want to put my money in healthcare stocks. So can decide on different sectors of the economy that way. You can just decide to have, a bit of a balance across, look at different sectors of the economy and say, who are the top players here? I'll have some shares in Disney, so I know that I got some entertainment. I'll put some money in Chevron, so I have some exposure in oil and gas. I'll put some money in Facebook and Google, so that I have some money in tech. I'll put my money in JP Morgan or Visa or PayPal, so I have some exposure in finance. So, you can spread your portfolio out that way across different sectors, regardless of how they are performing or whatever. You can still look in and do your due diligence against, returns or the performance of the company, but you can spread it out that way against market segments. And then, look at, other economies or the market cap of the company. Funke, I think we're a bit pressed for time, aren't we?
Yes, it looks like it. So maybe I want to ask what people want to say. Do we want to ask questions now, or do we want to have a continue on a few more slides? Do we have questions? Does anyone have any question already? You can unmute yourself and ask your question if you do. if we don't have any questions, I'm trying to see if anyone is raising their hands that I can't see, but I don't seem to see that right now. So maybe we can just continue with the slides. But if you have any question on any slide, please use the raise your hand button and we can just answer it there and then before moving on to the other pages.
Okay, so how many minutes more do you think I can carry on for slides?
Let's say another 5 minutes and then we'll see if there are any questions.
Okay, all right. So I'll just do due diligence for looking at dividend shares and growth shares, and then we'll, in the next 5 minutes. Okay, so if you want to buy shares that are good for dividends, there's some things that you need to look at when you're doing your research. First thing you want to look at is how well does this company pay out dividends? Do they have a history of paying rising dividend payments? Because it's not enough for a company to just be paying 10 pence per share every year or every quarter, year in, year out. You want to see that they've gone from 5 pence a share, 7.5 pence a share, to 10 pence a share, 10.5 or 12.5 to 15 pence a share. So there are different ways you go through that. I was going to show you on Yahoo Finance how I do my research. But if you go online, there are companies that are classed as dividend kings. They've been paying shareholders increased dividends for the past 50 years. So you know that it's a company tradition. If you put your money in there, it's sure you'll get your dividends regularly. There's not going to be any story. The dividend aristocrats, those are companies in the S&P 500 that have been paying out increasing dividends to investors over the past 25 years. And then the dividend champions, they are not always on the S&P 500, but they've also been paying rising dividends over the past 25 years. You want to look at the company's most recent quarterly statements. You want to look at their balance sheets, their income statements, their cash flow. Do they have enough assets to cover their liabilities? So again, it comes down to, having a little bit of a finance head. And if you run a business or if you're in finance, it's good to be able to know how to read balance sheets and P&Ls. But I could show us on Yahoo Finance if we have a few more minutes. What you want to do is get a clear sense of what is the fiscal strength of this company. If they're hit by a lawsuit, if they're hit by a regulatory issue, will they have enough money to bail themselves out, or will they be going to the government or to the banks for a bailout or for a loan? You really want to test the financial strength of the company by looking through the numbers. And then you want to look at their website. You want to look at who their competitors are. Are they in a very active, turbulent sector where there's a lot going on? Or are they kind of, have that comfortable first mover advantage where, they're the leader by a mile, they're leader by a very wide gap. And before other companies will catch up with them, it will take a while. So you can look on Yahoo Finance, Google Finance. They've got good charts, good data about what's going on in companies, and then they keep it up alongside with news articles and the financial analysts' recommendations. You might want to read, what the financial analysts are saying about companies. They always give quarterly recommendations. So big companies release their earnings statements or their earnings results every quarter, every 3 months. So before then, analysts will be saying, right, last quarter they did 500 million. This quarter, we're projecting they'll do 650 million. If they do 650 million or between 625 and 650 million, the share price should go up by 10%. So, you can read what the analysts are saying on Bloomberg, on CNBC, on Barron's, on those sorts of websites, and get an idea of how a company is performing. And then, there's some industries where they are reliable, sustainable cash flow businesses. So companies in utilities, your power companies, your telecoms companies, they're the ones that are collecting money from you every month by direct debit, isn't it? Because they know you will always pay your bills. You don't have any choice. So they have good cash flow, reserves. So they're good for paying out dividends because they don't need to go to the bank. They have money for their operations. If they want to expand, they've got money for it. So if they say, okay, we can pay out 30% of our profits as dividends, they're very good for dividends. And then you want to look for companies that are in, like my, I don't know if we're all Yoruba here, aye businesses. That's what my dad used to call them, businesses that they can't go out of business. Coca-Cola, everyone's going to drink Coke, regardless of how bad diabetes is. Everyone's going going to drink Coke. Everyone's going to buy McDonald's, you know. So, you know, telecoms, banks, utilities, real estate, people are going to need a roof over their head. They're not good. Not everybody needs a Tesla, but everybody needs a house. So, you know, you're going to need them year in, year out for as long as the earth remains. So those are companies that are good for dividends. Okay, I can see a few. Show some practical research.
I think maybe the person wanted to
show
the Yahoo. Yeah, I was actually going to let you finish and say maybe we should go to Yahoo Finance.
Okay, all right. So I'll do that. Let me just quickly do the growth side so that I can show you both when we look on Yahoo Finance. So with growth shares, again, you're looking for companies that are doing more than 10% annual return, earnings growth, more than 10% annual return. So the company's balance sheet, the company's earnings, P&L, is growing by more than 10%. And then the company's profits is also growing by more than 10%. That means they're acquiring new customers and they're finding more efficient ways of reducing their costs as they're increasing customers. So they're growing their earnings, their revenues, and they're growing their profits. Those are kind of companies that are growth companies, but they're doing it consistently. They're not doing it in year one, and then they have a dip in year two, and then they go again in year three, and then they have a, no, they're doing it consistently on a constant trajectory. So those are growth companies, because the average, if you look in the developed world, not like Nigeria where, you know, people tell you that a company is doing 30% a year. Those are very crazy numbers. In the developed world, the average returns is between 3 and 5% on most asset classes, bonds, gold, property, 3 and 5%. So when you have a company that's doing 10% in a year, that's fantastic by developed world standards, because it takes a lot to keep your overheads and all the regulations and taxes running. So you have a business that's doing more than 10% a year. Wow, they've got something that everybody wants or everybody needs. So that's how you look for growth companies. But then you also want to look at their management team. You know, who's heading them? What's their pedigree? Where did they go to school? What's their experience in that sector? Have they led other big cap, mega cap companies? Have they sold other companies? Have they exited other companies? You know, someone like Sheryl Sandberg left Google before she went, she left Google before she went to Facebook. So, you know, there's that track record there of people who are able to do big things, great things in business. And then you want to look at their brand. Do they have a strong brand? You know, a familiar identity. Millions of people recognize the brand, because that's not an easy thing for a company to achieve, where someone sees your logo and they know that that's you. And then there are high barriers to entry. Before you want to start that kind of business, you know, you need to sit down and think. So their competitors are not going to be easy to come by. So, you know, think of a company like DHL or like FedExpress. Before you want to start a global courier business like that, you've got to have billions in the bank, you know. So they have a fantastic high barrier to entry. Not just anybody can come in and say they want to run logistics at that sort of scale. And then you want to look at for companies that have R&D vaults. You know, they have high amounts of patents, intellectual property locked up in their vaults, you know. So your big pharmaceuticals and your biotech companies are good ones in those sort of areas, because once they have those products, they've locked them into patents where it's not easy for anyone to come in, and they have the first mover advantage. So let's quickly jump onto Yahoo Finance. I don't know if you can still see my screen.
Yes, we can.
Okie dokie. So let me go back to the beginning to do this again. So I'm going to use Disney as my example. I don't know why I chose Disney this time around. I usually use Coke. But I'm going to use Disney and Netflix as my example. So if you come into Yahoo Finance and you say Disney, right, they'll come up with this summary page first of all. It's got a whole raft of information on here. So there's news articles, what's going on with Disney from different, and it's aggregated from different news websites. You can see here the Motley Fool, Simply Wall Street. This is a Yahoo Finance article. Motley Fool, Zacks, Reuters. So there's quite a wealth of information here about what's going on in Disney. And then the next thing I start to look at is the charts, because that usually just jumps out at me first. So this is a one-day chart, and you can use the charts over a period of time. So I usually start with year to date, because that's just exactly 12 months from today. Okay, so he adjusts it for that. And you can see that it hasn't really moved so much. In fact, it's trading lower today as opposed to where it was a year ago. Yeah, so if I'm a firm believer in Disney, now is a good time to buy it, isn't it? Because it's a little bit at a discount. If I go back 5 years, then you see it's a completely different picture. Okay, so obviously this is COVID. That's this big slump here. But look at how much is recovered in that time. It's gone. This is 1st of March 2020. It was at 96.60. Okay, and trading at almost 160 today. So it's gone up almost 60% in that time. So if you're putting 1,000 at this point, you'll be sitting on about 1,600-ish now, which is really quite remarkable, isn't it? But it's still got headroom. I mean, look at its figures as at February, and we know the market has been sluggish a little bit with all of the everything going on in the US with inflation and blah, blah, blah. So there's still potential for headroom. And then what I usually like to do next is, if you look at this 52-week range here, I don't know if everyone can see my arrow.
Yeah.
Yeah, so you can see that over the last 52 weeks, over the last 12 years, at its lowest point, it was at 140.86. At its highest point, it was at 203. So that means there were people willing to pay up to $200 for this stock. So if I'm buying now, I'm potentially looking at about $40 in profit on 150 or 160. That's about a quarter, 25%. I'm happy with that. So, Disney is still trading at a discount right now. Even though you could potentially have Disney in your portfolio, it's still a good time to buy, okay? So that's what that is. And if you want to look at the volume, you just want to see how much people are buying in a year or how much people are buying in a day, which doesn't really tell you a lot, really, because some of it might be institutional investors that have billions sitting aside. They just, once they see a $1 dip, they just buy 1 million units. Okay, so here's Disney's PE ratio. Disney's trading at 145.91. So that means you're going to buy, if you buy at about $145, you're doing that for $1 in profits, which is quite high. But then regarding the fundamentals, I know, or that you would know about Disney, you can, and if you want to look at how much of a diversified company it is, because when you see a PE ratio that's that high, you want to look at what are they doing that justifies that price point. Sorry, so if you click on this profile button here, that just gives you everything there kind of is to know about the company in a bit of a nutshell. So here's his registered address. This is his management team, right? This is what they get paid, fat cat salaries, and then description. So what I'm really interested in is subsidiaries, okay? So Disney here operates cable networks, Disney, ESPN, Freeform, FX, National Geographic. Okay, it's got all of its parks and experiences, the Walt Disney Resort, Disneyland, blah, 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 and that's all over the world. It's got a cruise line, and then it's got its studio where they produce movies, Walt Disney Pictures, 20th Century Studios, Marvel, Lucasfilm, Pixar. So it's not just a one product company or a one service company is what I'm trying to say. It's got multiple revenue streams. There's so many lines of business within this one business. that generate revenue. People are in Disneyland every day, in Paris, in Florida, in California. People are watching all of these movies every day. They're selling out box office tickets, and then people are streaming. So, you know, they're streaming Disney Plus, Hulu, ESPN. So there's multiple streams of income. So that probably justify why it's trading at that EPS, at that PE ratio we saw earlier. Do you get what I mean? So if we quickly go to, I'll show you the dividend data now. Historical data, that's where that usually sits. You want to look at the time period. I usually do 5 years or max, okay? You want to look at dividends only. Doesn't matter what the frequency is. You can pick anyone. It will just and click on apply. So going down, you'll see how much Disney has been paying in dividends since 1962. Okay, so this is quarterly. So you can see March, June, September, December, March, June, September, December, March, June, November, March, June, September, November. So it goes on and on every quarter like that. And what you can see here is the dividends are rising every single quarter. As you're going up, you know, it's going up, okay? So here we're at 3 decimal points, and then at 2 decimal points by 1983, and then at 1 decimal point, yeah, as at 1990. And today they're paying, you know, in the tenths of pence, so they're paying 88 pence. And so it's a dividend king. It's paying out consistently, 1963 to now. That's 50 years yet? Not yet. Well, it's before I was born, so it's knocking on it. Yeah, it's more than. 71 would be 50 years. So yeah, it's more than 50 years. So that tells you it's a company tradition. It's reliable. It definitely justifies, it justifies, I shouldn't say definitely, it justifies that price point with its PE ratio. In terms of looking at the financials, I'm going to be very, very quick with this. So if you don't understand, well, I'll try to make it as quick as possible. So this is its total revenue. This is its income statement. So this is profit and loss statement. So this is for the year ending September 2018, September 2019, September 2020. P&Ls usually come in 2 years or 3 years so that you can compare the previous year against the current year. So you see here at 59 billion, because these numbers are in thousands, 59 billion, it's gone up to 69 billion in 2019. So that's about $10 billion increase. And then, yeah, we all know COVID happened, but in spite of that, look at that, it's just a marginal drop of about 4 billion. Okay, a lot of industries, the airlines were pretty much wiped out. So I mean, people were still wanting to go to Disneyland or wanting to watch Disney Plus. And I think Disney Plus is a big factor in them being able to keep this amount of revenues. If you then come down to total operating expenses, so you're looking at operating expenses of 11 billion on 59 billion, okay? It takes a little bit of calculating, because what you want to do is look at what percentage of this is this, of this, yeah, on this, what percentage of this on this, what percentage of this on this, and see if as a percentage as the income is growing, is the operating expenses reducing, because your operating expenses are your overheads, they're the things that you're spending money on every day. It's your payroll, it's your utilities.
Dr. Funke,
yeah.
Someone said you should zoom in your screen a little bit.
Oh.
I think they can't see it very well.
Is that better?
Yes, definitely.
Okay.
Thank you.
All right, so you want to look at this as a percentage of this and see how it's going up or it's coming down. Do you get what I mean? So it takes, like I said earlier, it takes a little bit of financial analysis or a little bit of financial mathematics. But if you look at the operating income or loss, you can see here that they did 14 billion in profits, then 11 billion, then 3.7 billion. So there's a significant, even though there's a relative drop in income that we said was great here, this is not so great. This drop in profit, because it's from 11 to 3, and that's where you probably see the pressure of the pandemic, of COVID happening. Right, so so if you come down to net income, which is after taxes and after taxes and depreciation, what you're now seeing is a net loss in 2020. Yeah, so if you move on to the balance sheet, the balance sheet is a breakdown of assets versus liabilities. Your P&L is your trading statement, tells you about money coming in and going out, but your balance sheet is on assets and liabilities. So these days you can see here, if you look at total assets, total current assets, which is liquid assets, assets that they can sell within 90 days for cash. So it's cash in the bank, receivables, inventory. So that's showing a steady pattern of growth, okay? That means there's a reserve to weather the storms. And then if you look at total assets, again, they're building up assets as they're going along, right? This is really quite remarkable in terms of growth. So you might want to subtract this from this and then see what the percentage on this is to see what the growth in assets is. Subtract this from this, divide it on this and see what the growth in assets is. And then look at that against liabilities. So just looking at assets against liabilities, if there was anything, God forbid, that meant all of these liabilities became due in one day, because that's the thing with business. If it was a company that was presented with bankruptcy and it needed to clear all of its liabilities in a day, Disney has enough cash or enough assets to clear its liabilities and still keep a reserve. So those are the kind of companies you want to invest in when you're looking for dividends assets. You've seen there's a strong history of paying out dividends. They've got a good quick ratio. Your quick ratio is total assets over liabilities. That means it's more than one. You've got enough assets to cover all of your liabilities. There's growth in revenues. And even though there's a dip in profits, the asset base here justifies that, you know, they've got enough reserves to reinvent themselves and carry on trading, and then recover their profit margins. I don't know if we have time to go through Netflix, because I wanted to compare Disney with Netflix, but it's a similar sort of analysis you do. You just go through these headings under Yahoo profile. To keep it simple, the summary, the historical data, and financials, and the profile. Those four, those are the key things that you look at. You may want to look at holders, who are the people that hold stocks, just to see if they're buying or selling a lot. These here are the, hold on, let me see what the analysis, you might want to look at the analysis. So what are the analysts saying about Disney? So this is usually what I look. You know, out of 30 analysts, 17 are saying it's a buy. That was as at August. 25 are saying it's a buy. 25 are saying it's a buy in September and October. You know, and a few people, 15 people less are saying it's a buy now. More people are saying hold. You know, if you have it, just hold, don't sell it. Sometimes you see that the sell point goes up, and you know, people are saying sell. So that kind of gives you a starting point for how you start to do your research when you want to look at shares for dividends or for growth. And I don't know if anybody has any questions at this point.
If you have any questions, you can unmute yourself and ask your question. Okay, I'm going to ask a question, just a very short, quick question. So I see that you talked a lot about the P ratio. Mm-hmm. What is the, should I say average, above which we can say it's looking good and below which we can say it's not looking very good?
So the P ratio is a very arbitrary, it's what a lot of analysts use, but the way in which it's actually calculated differs. Okay, so the formula for the PE ratio is actually the share price. So it's price earnings ratio, share price divided by earnings per share. Okay, now some people will say the share price, they'll use the share price as at today, or as at the time it's being measured, divided by the earnings per share. Now the earnings per share, is that the earnings per share as at the last annual financial report? Or some people use what they call TTM, trailing 12 months. So as at the last 12 months, so if you look at where we looked at the financials here, you see this is as at September 2020, but the trailing 12 months is a moving average because this is 14th of November 2021. It goes back exactly to 14th of November 2020. Okay. Do you get what I mean? So people will use that. Some people will use the quarterly earnings. They'll say, we only care about the last quarter. So the earnings for that last quarter is what we'll use to. So the PE ratio is not always a fine, not always a fine science, but it differs across different sectors. In food and beverage, you might find, you know, the average is maybe 20. I usually, ballpark, I think from reading through so many things, people just say 25. 25. It's about, well, I think that's because Warren Buffett championed 25. It was always like, if a company is more than a PE ratio of 25, it's too expensive, so he doesn't buy it. Not that he doesn't, yeah, he doesn't buy it, or yeah. So that's why he was a very late investor in companies like Apple and Microsoft, because he just felt, what are these people selling? There's no physical product and that justifies this price point. But, you know, Tesla is trading at a PE ratio of almost 600, you know. And what do they do? Cars. You know, we haven't seen their charging stations. We haven't seen the solar panels in the ceiling. We haven't seen cars. But, you know, if you look at a company like Toyota, Toyota makes probably 10 times more cars than Tesla does, right? And at the price point that one Tesla costs, you probably buy 3 Toyotas, right?
Yeah.
But it's not apples and apples. You can't say that Tesla is an automobile manufacturer, simply just an automobile manufacturer. You can't, because there's a whole lot of R&D locked into autonomous driving. There's a whole lot of R&D locked into electric power charging, you know, be that buses, trucks, and all of that. So yeah. It's difficult it's a difficult science. It's a difficult thing. What I don't rely on just the PE ratio alone, because you just can't. You might say that the company is too expensive, and then the price, I mean, look, Tesla again comes to mind. Look at it went up to $600 at some point last year. Then it crashed to 400 and a bit. And now it's at 1,000 plus, you know, and then it went to 1,200. And then the silly guy sold like 5 billion and it crashed again. So, you know, it's not, the market in that is not responding to the PE ratio. It's responding to Elon Musk. You understand? It's not, the market is not responding to the PE, it's responding to just one guy and what the guy is doing. But in some other sectors, the market responds to the financials. You know, if it's healthcare, it's looking at that. But some other times, the market is irrational. You know, someone might come out and say, you know, Mark Zuckerberg has done something, and then Facebook shares crash. So it's always a lot of things put together, that justifies it. But in terms of a number for the period, I would say, you know, just go with what is the average in that sector. If you come here and you see people also watch, or so on this Disney, you can see Netflix and you can see Amazon. Then you can do the financials, divide it, or just copy out the PE ratio for here. Netflix is 145.9. Sorry, Disney is 145.91. Netflix is, can you still see my screen?
Yes.
Netflix is
61.
Yeah, so you can go and maybe look at what was another big Comcast or something. Look at another one like that, and then use it to. But they all have different things going for them. They all have different arsenals, things in their arsenal that they have going for them. So I wouldn't say pick Disney over Netflix. I would say buy the two, because you know they're expanding in so many different directions. But yeah, it's very interesting, and we can keep talking.
Yes, Thank you so much. This has been amazing. Does anyone have any question before I start to round up?
Or anything to add? Because I'm mindful, I've just been saying so much.
If you have anything to add, any question, any follow-up, just feel free to go ahead.
Okay, can I say something?
Yes, you can.
Okay, thank you very much, Ma, for this very rich and in-depth, in-depth for this level, in-depth kind of exposition over the capital markets. I wanted to ask if you know of apps or platforms where that is generally available in Europe, where people can buy these stocks and they can just always watch or observe, maybe on their mobile or something. If you know, it would be great that you share with us. And of course, I wrote it in the chat earlier. I don't know if that presentation you shared is something that you can pass across to us.
Oh yes, definitely. I'll share that. That's not a problem at all. When you say in Europe, do you mean you live in Europe and you want to buy European shares, or you live in Canada and you want to buy European shares?
I actually live in Germany, so yeah, I want to buy shares more or less globally, or I mean, German shares from my research are not the. I mean, it's the environment is not. Germany in general is not that the stock exchange is not as booming as we have, for example, in the UK or clearly in the US. So, but
I might need to do some research for you to find out, because it's not one of the most. It's not. I have a friend who lives in Norway as well, and I had to do some research for her to find the types of the platform that would have the types of shares she wanted to buy. But she also wanted to buy American companies while living in Norway, and we found that it was a bit tricky. So it depends on the platform. So if you see someone like Interactive Brokers, you can see they're in the US, they're in Canada, they're in Australia, they're everywhere. So that means they have agreements across jurisdictions. They have, you know, banks working with them and all that. So it might be one to look for. Saxo here says Saxo is in Europe. I don't know, have you tried Saxo?
I have found out about them, but I was not able to come up with anything.
Okay. What about Interactive Brokers? Because I can see them here as #1 in Europe.
Okay.
Have you tried
No, I have not done anything with Interactive Brokers. What I actually discovered is that, and in my opinion, they are just new wave of platforms that are springing up. You might not want to just commit to them. We have, for example, Trader 212 or something, or eToro and all that. So I mean, for example, for eToro, I know that people lose their money a lot. I don't know what goes on in the background, at the back that happens that make people lose their funds. But yeah, so one just wants to be careful, and this environment is also quite how do I call it? I don't want to say restrictive, but yeah, Germany in general is very conservative. So it's not a subject that you hear among the young people, for example, shares and all that, like you would, or stocks like you would see in the US. So
okay, if you do have Interactive Brokers, you can check, because we have Interactive Brokers in Canada, and I know that it's legit. Like, I have an Interactive Brokers account myself, and I don't have any issues with them. So if they do exist there, I think they're a good one that you may want to try.
Okay. Okay. I'll check that.
I think look into Interactive Brokers. Try Fidelity. Fidelity is quite global as well. And yeah, you're right. You don't really want to go in with the new ones that are popping up, because what a lot of them do in the background is arbitrage. They'll buy shares on your behalf, and then if you give the instruction to sell, they'll wait until it's at a price point that's favorable for them before they sell, and that's why people end up losing money. So yeah, go with the old or, like I would say, established global brands for a trading platform.
Okay, I'll check out interactive brokers.
Yeah.
Okay. Thank you so much, Dr. Funke. As in, even I have heard you teach about this, but I've still learned something new again today. Thank you so much for making out the time. This is really rich. I'm not surprised that a lot of people are already asking for the slides, because I know you didn't even go through everything, but even the ones that you touched is really well packed. Thank you for making our time. Thank you for sharing from the wealth of your knowledge. We are very grateful. I hope everyone has been able to get something. Guys, let's give her a warm round of applause. Let's get our smileys and appreciate her for the time and the knowledge.
Oh my word, where did all that come from?
Thank you so much. It's been a wonderful session. We are very grateful. I'll reach out to you outside of this for the slides, because I'm sure people will be in my DM shortly asking me for it. So I'll talk to you after this to get that. And I wish you a wonderful week. Thank you. I know guys, again, she's in the UK, so this is literally like 10 p.m. our time or something. So I know that this is a really great sacrifice. Thank you so much. We really appreciate it.
No problem.
Have a wonderful week. Thank you everyone for joining. I wish everyone a wonderful week.
Sorry,
thank you.
please,
Thank you.
may I ask how or where we can connect with her?
Outside of getting the slides?
Yeah.
Okay, now let's take that offline.
Okay, thank you.
So,
yeah,
you can, yeah, sure. Funke will give you my details. Funke will give you my details. Yeah,
thank you.
Yeah.
All right, thanks again, everyone. Have a lovely week. Thank you.
Regards.
Thank you, Dr. Funke. Regards to the family.
Yeah. Thank you, everybody. Nice to meet you all. Thank you.
All right, bye.
All right, bye.
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 Bye.